Hello again. And first of all, I'd like to wish you a happy new year, and I hope that 2016 is a good year for you in your business. And when you go into a new year, it's always a good time to review things. So I thought I'd put together a short article giving you 5 tips to improve cash flow for your business. As we all know, cash flow is the lifeblood of a business, and if your cash outflows exceed your cash inflows for a long period of time, you won't remain in business for very long, that's for sure. Now, as you look down this article, I actually wrote a white paper on Cash Flow is King. So if you want to have a read of that, it's quite a useful article. You can download it and print it out if you want to. But keeping cash in mind with healthy profits, this is a very good recipe for growing your business. So without further ado, let me just have a look at the 5 tips. And the first one is to review your debtor days. Now there's 2 elements to this. It might be that you allow your customers to pay you in 30 days, 60 days or whatever it is, the term you put on your invoices, and you might want to review that and say, well actually instead of being 60 days, I want you now to pay me in 30 days, or you might want them to pay you in 14 or immediately. You can set the rules, but be cautious because customers do have a choice. And if they can find somewhere else that will give them a better credit term, they may go somewhere else. But don't necessarily let that put you off. There will be room for negotiation, particularly with your bigger customers, where they have a bigger impact on your turnover and your profits. The second element to your debtor days is whether your customers are actually complying with your payment terms. So for example, if you do allow say 30 days or 60 days, but actually instead of paying in 30 days they're taking 45 days or even 60 days, and this will all depend upon your credit function. So make sure you review your credit function and make sure you are sending out reminders, make sure you are chasing up your customers in good time. Put it this way, it's better to have the money in your bank account so you can do something with it, grow your business, invest to take it forward, rather than having it in your customer's bank account. So speeding up your customer payment terms will improve cash flow, but improving your credit function and tightening up on how long you allow your customers to pay will significantly affect your business cash flows and will result in a better bank balance. Number 2, here it's to review the timing in which, or the time you take to raise your sales invoices. And I'm going to talk about this by way of an example. A company that I had as a client when I had my own chartered accounting practice, they were taking some 5 months, yes 5 months, to raise their sales invoices, and then they were allowing their customers to take 30 days to pay them. So it was taking 6 months before they had the cash in their bank, and then they wondered why. They were always running to the limit of their overdraft facility. They could never afford to pay their sales tax or VAT in the UK. So this was something that I consulted them on, and this is something, it was a very quick win to improve their cash flow and improve their business by making sure they get their invoices out on time. Now I would argue that you should get your invoices out certainly within 24 hours of supplying the product or supplying the service. It may even be, if you have a website, like for example we do, Bowraven, we ask for payment up front before we ship or before you can download the products. Of course we sell all over the world, so we can't really trust, inverted commas, people that are in the other side of the world to say, well okay, you can download a product and then pay us afterwards, because of course going across boundaries it's very, very difficult to chase that payment. So that's one of the reasons why e-commerce people ask for money up front. However, when you're working within the same territory, so say for example in the UK, people do supply product, invoice and then get payment afterwards. So it's important that you raise your invoices very much on time. Otherwise, this will add to the timing before that money is in your bank account. Number 3 is asking for extended credit terms from your suppliers. There are 2 elements to this. One is actually making sure the actual credit facility you have is sufficient for the volume you're putting through that that supplier, but also, but more importantly, is asking for time to pay. Certainly when you first start up your business, it's very difficult to get credit sometimes, and it may be that you had to pay before you got delivery or cash on delivery, and it might be time to review that. Starting a new year is always a good time to review, particularly if you've got a set of accounts under your belt, and particularly if you've been showing a profit in those accounts. Now's the time to approach your suppliers to say, could we have at least 30 days to pay our invoices? Or you could even ask for longer payment terms than that. And this is a free source of business credit. And of course, it means that you'll keep more money in your bank account, and it allows you to use that money for other purposes to help grow your business. Now, of course, if the supplier that you get that particular product or raw material, whatever it is from, says no to increasing or to extending your credit terms, then maybe this is the time to review other suppliers in the market. But make sure that they supply either as good as or a superior product or raw material, or if it's a service, as your existing supplier, because you don't want to lose out on quality of product just to get some better payment terms, because that's not good business. Number 4 is to create a budget. Now, by creating a budget, there are 2 essential elements to this. There's the income and there's the outgoings. So by setting a budget forward, it sets your thinking of what income you should have, and it also sets your thinking of when those monies should be in your bank account, and then you can set about making sure that the plan you set out happens within your business. So the budget will show you what your expected cash inflows are and your expected cash outflows. When you're looking at putting the budget together, you should be looking at your sales cycles, the payment terms for your customers, potential discounts they receive, your cost of sales and the supplies you use, together your overheads, and review all of these at the same time as putting those budgets together, as this is a good time to do that. And I always like the saying, failing to plan is like planning to fail. So by preparing budgets, you're setting out a plan, and it's much easier to hit a target that you've set. So if you don't have a plan, it's very difficult to run your business. And there are more businesses that succeed that have plans, and conversely, there are more businesses that fail that don't have business plans. Number 5 is, once you set a budget, is to monitor the results. There's no point in setting a budget and then filing it away in a drawer and not actually using it. And I would suggest that you do this at least on a monthly basis, but depending on where your business is, if it's got a few cash flow difficulties, I would do this on a much more regular basis. You should be comparing your actual cash flows with the budget to work out where you are, and to review where things aren't perhaps going to plan, and to make sure that these don't impact on your cash flows too significantly. Make sure you work out any reasons for the shortfall, and make sure that you're on top of this at an early stage so that you can stave off any longer term problems. Are your cash outflows greater than what you budgeted for? Are there some unusual or unexpected expenses that have cropped up? If so, you need to build these back into a revised budget and cash flow to make sure that your business will have the necessary cash to continue through. I always like the saying, what you measure you will manage. So by setting out a budget and monitoring that budget and monitoring your actual cash inflows and outflows versus what you budgeted for is a good way of making sure that your business will succeed. Now, interestingly, as a result of writing this article, I thought to myself, well, actually, it would be very useful to have a tool that you could actually work out the impact on your business by making some changes to your customer payment terms, to how quickly you raise your invoices, to changing your suppliers or the supplier payment terms. So I've written what I've called a cash flow improvement tool, which you can download by clicking here. It's a free business tool, and basically what it does is it looks at your business in an isolated period. So you ignore brought forwards, you ignore carry forwards, but you look at, say for example, a 12-month period of your average sales, your average cost of sales, your average overhead and wages, and then you apply to that what your existing customer payment terms are, how quickly you raise your invoices, what your supplier payment terms are, and then what you do is to play around with different scenarios. So, for example, you might want to reduce your customer payment terms from 60 days down to 30 days. It may be at present, perhaps you're taking a month to raise your sales invoices. What impact does it have by speeding that up and raising them within 24 hours? The cash flow improvement tool will show you how much extra cash you'll end up having in the bank as a result of doing this. What it won't do is to show you what you could do with that extra money outside of putting in various interest rates for either running an overdraft facility that you might be doing now, or earning a bit of interest income as a result of turning around the amount of cash you have in your bank. But that's not where you should leave it, because if, for example, you've got, say, an extra £50,000 in your bank, think about you could spend more money on marketing and advertising to grow your business faster, and then that becomes a snowball effect, because if you maintain your better way of dealing with your customers and getting the money in, and a slightly delayed payment terms with your suppliers, you'll get more cash into your bank, and then you can put more of that back into advertising and marketing and grow your business and so on. The other key benefit is that you could perhaps take on another member of staff because you can now afford it, because you've got more money in the bank. And that particular member of staff, maybe you could put into your customer service function. To improve customer services, there's more likelihood of getting a referral, and you grow your business and so on. You get a much better reputation, so you get that snowballing effect. So I thought this would be a very useful free business tool for businesses to download. So please, if you feel free to go off and download that and have a play around with your figures. So that's all I want to say for now, and thank you for listening, and bye for now.